Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today we're going to be talking about a strategy that some traders turn to when they want to do sort of a more measured entry into a stock that they want to own, but maybe there's something right around the horizon that has them intimidated, like an earnings announcement. So today we're talking about a strategy known as a married put strategy. Interesting. This is a strategy that can still deliver the unlimited upside of stock ownership, but with limited downside risk exposure. So it sounds awesome, but what are some of its possible shortcomings? We're going to be looking at both sides of that coin in good detail. Before we can get to any of that, though, let me first of all say hello to everybody who's already joining us out there in YouTube. Great to see Andrew and Hovis, Frank, Joe, Posh, Kevin, Jack, Lawrence, Ricebird, Eva, Richard, everybody else. Thanks for joining us week after week. We always do really appreciate your attendance and your contributions to these discussions. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after this live stream is concluded, we'll enjoy the recording. That's a great way to watch these webcasts. But also be aware that you're invited to join us in the live stream if you'd like to be here. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. It'd be great to have you here. Also, as a special treat for my live stream audience members, we have Kevin Horner hanging out in the chats with those that are joining us through YouTube right now. Kevin's going to be watching for chat questions. If I can't get to those, Kevin's going to pick up the slack there for me. Thanks for having my back there, Kevin. And Kevin and I would like to issue an invitation to everybody watching. If you have an account on X, you should be following your favorite Schwab presenters there. It's the best place to connect with us in between the live streams. You can find Kevin on X at Kevin Horner CS. You can find me there at Cameron May CS. But let's get into this discussion of married puts. And as we do, of course, there are risks associated with this strategy. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so with that said, let's set an agenda for today's discussion. So I wanted to talk through the pros and the cons, the potential advantages and the potential risks associated with trading this strategy known as a married put. But I would suspect there are going to be plenty of you who aren't familiar with this strategy at all. So we're going to go to a pace that everybody can follow. We'll start off by setting up an example stock as a possible trade scenario. And then we're going to talk through maybe placing an entry for that stock, including something known as a married put. So I'll explain what a married put is. We'll weigh its pros and cons. And before we get to the end of today's discussion, we'll even enter an example trade on the Thinkorswim desktop platform. So let's go right to Thinkorswim. And let's put ourselves in the shoes of a theoretical investor here. Maybe they've been following Carnival Corporation. They noticed that it's trading well below all-time highs, but it's been working its way higher since we hit those April lows on the wider markets. Carnival's been having a nice run up. However, recently, maybe our trader observes it ran into a price ceiling around that 30.50 level. Finally broke up and through right here. What was that? August 22nd. Strong breakout on a high volume, large candle day. And since then, that's been a pretty serviceable support or a price floor. And maybe what they see with today's activity, we're up about another 1.4%, possibly Carnival's set to go higher. Now, how much higher might this go? Who knows? Time will tell. May go down, but it's certainly been higher in the past. So if you look at where Carnival is right now on a 10-year chart, you can see that it's been about double. Not quite double. Yes, double. Back in 2018. Now, time will tell if we actually go up there or not, but let's say that our trader has that longer-term conviction, so they're ready to buy Carnival. But they notice something. Might throw them off the scent entirely. What's right around the corner for Carnival Cruise Lines? There's an earnings announcement. Earnings can go well. They can go poorly. They can go okay. But Carnival has an interesting history with its earnings. If you look at the last earnings announcement, it really spurred an explosive move to the upside. If you look at the earnings before that, though, Pretty strong sell-off followed those earnings. Pretty strong sell-off here. There was a pretty solid sell-off here. This one actually, no, another sharp rally. Okay, so we're sort of 2 for 2. That's kind of a coin toss over the last 12 months. So now this could cause our trader some complete hesitation. Maybe they just decide to pull the plug on the whole idea, or at least put it off until they get clear of the earnings announcement. That's certainly something they might do. Well, for other traders, they may turn to a strategy known as a married put in these sorts of scenarios. So this would be a typical setup for the implementation of a married put strategy. It's typically applied when a trader is bullish on a stock, but they suspect that there could be some near-term volatility. And so they want to just try to reduce that downside exposure to a good extent. So here's what a married put is. It consists of two basic elements: buying a stock and buying a put at the same time. Now, that could also be correctly labeled as just a protective put. But when we enter the stock and the put at the same moment, rather than legging in, buying the call, or pardon me, buying the stock, and then maybe sometime down the line, buying a put for a period of time, that would be a more traditional protective put. A married put, you think of it, it sort of comes together as a package. You're probably thinking, where does the word married come from? That's it. They enter the scene together. All right, I guess that's the way that I think about this strategy. But we're going to marry the stock with the put. That doesn't mean that this is a long-term relationship, though. We're going to have a plan for exiting one or both of these positions. So how do we structure a married put? Well, it does begin with stock ownership. So if this is your first exposure to a married put, here are those two elements. We buy stock. And to make this a sort of a balanced marriage, in increments of 100 shares. Right now, nothing inherently wrong with buying, let's say, instead of buying 100 shares, buy 142 shares. It's just that we can't marry 42 shares with a traditional contract. Right? So we're going to buy the stock, and then at the same time we buy a put. So that is our married put. So let's talk through exactly what that would mean in this scenario as our example today. What the cost would be, what the pros and what the cons might be of doing this sort of an approach. Let's go to our trade tab. We know how much Carnival is costing us. At this moment, it looks like we might be buying 100 shares around $31 per share. Pardon me. Looks like it might be around $31.14. So let's just assume that we're able to buy those shares at $31.14 per share. And we're just going to do just one contract and 100 shares today. Sal makes a great observation. Sal, you are exactly correct. Is a married put really a synthetic long call? Wouldn't the long call be more capital efficient? It could be for a limited period of time. We know that a long call has an expiration. But yes, it does. And that's getting a little bit deeper into the weeds. I was trying to decide today, Sal, whether I try to tackle that in today's discussion. But you brought it up, and I'm going to commit to it. So let's make a note. Call me out, Sal, if I forget to talk about how this does have a similar profile to just buying the call. And why for some traders, they might just say, you know what, maybe I'll just buy the call. Okay. But let's just keep our focus at the moment on just this strategy. So buying the stock and then buying the put. Now, here's a decision that the trader might initially need to make. The stock ownership doesn't have a clock ticking on it. We can buy shares and hold them for as long as the trader chooses to, right? When buying a put option, there's an initial decision to be made. How many days do we want on that contract? So their contract's expiring as soon as the 26th of September, in just 3 days from the recording of this discussion, all the way out on Carnival Cruise Lines, we could go out to the 21st of January of 2028, 850 days. Now, there's a relationship between the time on a contract and how much that contract costs. So the trader might be trying to strike a balance here. getting enough time on the contract to get them through the volatile period, but maybe not so much time that the put is really, really expensive. So for some, in this case, it looks like our earnings announcement is really just in about a week. So we could theoretically buy a contract that goes out at least a week, maybe a few days beyond that. Some traders, though, might recognize that just because the event is past may not mean that the volatility is over. Look at these moves following earnings announcements. Did the stock just make its move and then sort of settle in immediately afterward? Or did it continue to travel for a period of time afterward? Yeah, in this case, we ran up for better part of 2 weeks and then started to settle sideways. In this case, there was an initial move up, but then peeled back for a couple of weeks. And that's kind of the pattern here. Maybe 3 weeks after this earnings announcement, maybe about 2 weeks after this earnings announcement. So S says, what are you trying to achieve with a married put? What's the objective? Well, the objective is to be bullish, but with limited downside. That's it. Okay. Now, if the trader is really convinced that this earnings announcement is going to be just fine, maybe they just buy the stock. And they just accept that they could be wrong and the stock could gap down. But what the trader, when they're doing a married put, the trade-off here is they're spending some additional money to limit that downside exposure. So at the same time, it's going to in the short term limit the upside potential a bit. Okay, but we'll talk about that. But that's a good question. Ask, what is the objective? The objective is to enter into a bullish position, allow it to be bullish, but to try to limit that downside. All right. So that's the purpose of this put, buying the put. And in this case, let's say that our trader wants, would the 17th of October get it done for us? Do we need to go out a little bit further? Maybe let's have a look. Let's look at maybe these 31-day contracts, or I'm going to go out to the 38-day contracts, those weeklies. These are going to be pretty fresh contracts. So the most distant weekly contracts are going to tend to be the ones with the lowest trading volume because they haven't been trading for very long. These are the ones that were just introduced. So the trader might first look to see, is there a huge spread between the bid price and the ask price? And in this case, it looks like it's just pennies. So it looks like that liquidity is already, it seems to be there for these contracts. Now we need to choose a strike price. Now, a traditional married put, if we're going to subscribe to traditions here, everybody has their own traditions. Anyway, I think it's most common if you do some research into married puts, the trader probably buys the contract with a strike price closest to the current price. So that's what we're going to be doing for today's example, just to talk through the strategy. But we could have chosen other strike prices. But when we choose when we choose a specific strike, let's say we buy the 31st of October and we're going to do the $31 put. Looks like that's trading. Let's say it costs us $1.75, just to use nice round numbers, somewhere between 173 and 179. That's going to change as we're talking because the markets are open. But here's what the trader is doing. They're entering into a contract that at the same moment they're buying the shares, and right now we're buying the shares for about $31. When we choose the at the money strike, that trader now has the right to sell those shares for a limited period of time. In this case, it's 38 days, but to sell those shares for basically what they bought them for, within a few pennies, up or down. Maybe it might be, a couple of bucks up or down on the higher price securities, but generally within a percentage point or two of what was paid for the shares. So conceptually, there is very limited downside on the stock. Now, you might think, well, if there's limited downside, there must be limited upside as well. Well, that's true to an extent. Let's talk about the downside protection that's offered by this put. So here's what we've done. In spending $1.75 per share, we now have the right through the 31st of October or for the next 38 days. If this earnings announcement goes really poorly, let's suppose we get one of these events. So how far down did this stock go here? It went from about 21 and a half all the way down to about 15, about $6.50 down. Do you know what that would look like from here? Right now we're 31 and a half. If we went down $6.50, that would take us all the way down to about here. Let me draw that in. That'd take us down to about 25 bucks. Now I'm taking this out. We should probably add a little bit more time. I like my visuals to be accurate. So let's come down here to our right expansion settings. And we had 38 days till expiration. That's 38 calendar days. In trading days, there aren't going to be quite that many. So let's change our right expansion settings to maybe like 30. If I click apply here, this takes us out to that 31st of October. That's going to be right there. You see that dotted line? Let me draw that in. 31st of October is going to be right there. So if I draw a line here, that gives us a visual reference point for how long this contract lasts. But if we were to get one of these moves, or to a lesser extent, one of these, that could be comparatively kind of devastating if we just own the shares. If we just bought the shares and the stock pops down here, ouch, that trader is looking at about a 20% loss on their shares. But with the married put, by spending the $1.75, we aren't obligated to sell the shares down here at 25. We actually have the contractual right. We have the right to put our shares into someone else's account for a fixed price. And that fixed price is 31 bucks. So if we bought those for 31.14 and we sell it for 31 bucks, that feels a lot better. We're only down $14 on the stock. So it seems like we've eliminated risk. Nope. We haven't eliminated risk. And Kevin's raised an interesting question or interesting observation. He said, married put equals gap insurance. Insurance is a term that I don't like to use with the options function, because while there's certainly some overlap between insurance and buying sort of protection using options, there are some significant differences between the traditional way that we think about insurance and the protection that's being offered on the options. So Kevin, I'm going to park your observation as well, because I do think it ties in, it's important. But there is protection being offered here. Even if the stock were to fall further, if it were to really start to collapse, and it could, you never know, especially when we have something waiting to throw a wrench into the works like a big earnings announcement, this could really start to move down. But for the next 38 days, our trader is comparatively unconcerned with that, because they do have that protection offered by that put. We have the contractual right to sell shares for 31 bucks. We're not obligated to sell for 31, but we have the right to. Someone S says, why would someone buy the stock at 31 if at the end of the option date the stock is 25? Because S, they're in a contract that requires them to. We paid conceptually we paid them $1.75 on day one. For the next 38 days, you have to buy my shares at 31 if I want to. It's not a matter of if they want to at that point. It's a contractual obligation on the part of the seller of that contract. We have a right, they have an obligation. So that's why. It's another great question. All right. So you might be looking at this and say, Cameron, this is a flawless strategy. Wow. Because if the earnings pops, I own shares. Let's say the earnings does one of these things. How far up did this travel after that earnings announcment? In about 2 weeks, we went from about 22 and a half up to about 30 and a half. That's an $8 move to the upside. Let me see if I can even fit that on my chart. So starting at 31, that would take us up to 39. Let me activate this drawing. And let's say that by expiration, we moved all the way up here to 39. Is that within the realm of possibility, given recent historical tendencies for this stock? We've talked about what could happen if the stock goes the wrong direction. Well, what could happen if the stock goes the right direction? With this apparently flawless strategy that Coach Cameron has introduced today. Well, we buy the shares at 31. the stock blasts off, it's up here at 39. We're looking at an $8 unrealized gain. Do we have to sell the shares down there at 31 even if we have the right to? Nope. That's probably a distant memory at this point. Now, because it's a distant memory, because we probably don't want to do that, undersell the shares at 31, but it means that we paid for some protection that we didn't need. We paid $1.75. That's not as much as the unrealized gain that we have on the stock, but it's still not inconsequential. We lost that value. So at that moment, this is very hypothetical at this point because this has not happened. But if we're up $8 on the stock, unrealized gain of $8 feels awesome. But our option, turns out we didn't need it. It has gone to zero value. We've lost $1.75. So that applies a little bit of a drag on the upside potential of the stock. And the specific amount of drag is the amount that we've invested. Okay, $1.75 in the put. So the stock from there, it can go up as high as it wants to go. If it, let's just exaggerate things just to see the potential of what could happen. I don't know. Maybe Carnival announces that they booked out for the next 5 years, and the CEO's a genius, and the stock triples between now and the 31st of October. Is it going to? Almost certainly not. But let's say it went to $100. We still own the shares, paid $31 per share. We paid $1.75 for protection to the downside that it turns out we didn't need. And so in that case, the trader's looking at $69 unrealized gain on the stock versus the $1.75 that they paid for the protection. And that, again, maybe was worth it. Where would it not be worth it? What if the stock doesn't do much? Well, let's say the stock has an okay performance after the earnings. It just doesn't move very far. Let's activate this drawing, and let's say it goes up to $33. $33 right there. So that's sort of in line with this trajectory that it's had. You'll notice on our chart here, this trend line has been a pretty good resistance at times. It's been a pretty good support. Now, let's just say it continues along that support line. We wind up there at $33. Okay, so now we have a $2 unrealized gain on the stock. Maybe a little bit less than that, more like $1.90 at this point. Jack says, why did you pick 31? Could have picked something else, right, Jack? What if I wanted more protection? Could spend more money and buy more protection. What if I thought I didn't really need the protection? Oh, maybe I'll spend a little bit less, get less effective protection at a lower price point. That's a possibility. So those are the choices. That's sort of the decision that a trader might be making in which strike price they choose. But in any case, if our stock's up here at 33 and we bought it for, let's do the real math, we bought it for 31.14, that would be $1.86. Awesome. In unrealized gain on the stock, except we spent $1.75 for our protection. Even though the stock has gone up somewhat, we're barely at break even. Barely at break even. Yep. If the stock doesn't go up more than $1.75, this trade will wind up underwater at expiration. Oh, why did we choose October 31st? Not many contracts. So, Jack, the reason for that was to get us through the volatility period. That was it. So we looked at historical tendencies for how long the stock was volatile after an earnings announcement, and the trader just bought protection for that time frame plus some. There we go. And October 31st kind of served that purpose. That with the earnings announcement out there on the 29th of September, that gives us a month beyond earnings for things to sort of settle out. Now, it doesn't mean that we're going to hold this all the way till expiration. But before we get to the management of the trade, I just want to talk about why, yes, this offers protection, but it's not perfect. It's not a perfect trade. So let's go back to Kevin's observation. It's kind of like insurance. Yeah, it's kind of like insurance. Let me tell you a story. This is sort of a sad story. Not sad. It's just sort of, for all parties involved, kind of annoying, right? So I have a daughter, 26 years old. 27 years old. Anyway, recently involved in a car accident. Nobody was hurt. Everything's fine. Basically, it was sort of a fender bender kind of an accident, but she was driving kind of a jalopy because she's young and doesn't have a lot of money. And so just that bit of damage that she had to her car was enough that it totaled the value of the car. Right? A few $1,000 is what we're talking about. It's fine. She can handle that. Even though she doesn't have a lot of money, she has enough. And of course, all right, Dad pitched in, helped out a little bit. Anyway, but she made an interesting statement. Well, she's like, well, thank goodness, I have insurance. Well, that's true. But I don't know about the thank goodness part, because think about this. If we've been paying insurance on a car, let's just say it's $100 a month, or okay, maybe even less. Let's call it $50 a month, just to be like, say we got a great deal on insurance. We pay $50 a month for 10 years. By my math, that's $600 a year times 10 years is $6,000 that we've spent to insure this car. And now to patch up the other guy's car and to replace this car, it wasn't a very valuable car. It was only worth a few $1,000s, and the insurance takes the deductible out, and they give about a $2,000 check to the insurance owner. So about a $2,000 value plus the repairs on the other car, maybe $4,000, $4,500, which we're glad we're not paying at the moment. But over the course of those years, we paid $6,000 for insurance. Now that's paying a small premium per month. Let's compare traditional insurance to this protection that we're buying on this stock. $1.75. Doesn't sound like a lot. $1.75. I have that much in my change on my dresser, right? Well, that's $1.75 per share times 100 shares is $175 that's being paid for 38 days. But if we put that in percentage terms, that's about 5%. Now, this is for about a month. Let's suppose that you were buying some fire insurance on your house, and the insurer says, sure, I'll sell you some fire insurance. It's just 5% per month. You say, wait, on my $500,000 house, that's $25,000 a month? Yeah, the premiums for protection on stocks are way different than premiums for protection on things like automobiles and houses. It's a huge difference. Why? Well, because your house probably isn't going to burn down anytime soon. Could, but almost no chance. This stock very well could go down in the next 38 days. So there is a much higher premium for protection. So I don't entirely favor comparing this to insurance. They're definitely shared elements, but it's not really a fair comparison. Is that okay? Okay, Kader says, sorry. Is this strategy, does it have any merits over the long term? I can't talk about tax. You asked specifically about tax efficiency. Cannot comment on that because I'm not a tax advisor. We need to talk with a licensed tax professional for guidance regarding trading and taxes. All right, but what about just doing married puts all the time? Well, I'm going to run some numbers here. Using this as our example, so we're just trying to get through a rough patch. There is an earnings announcement that will tend to spike the costs of the protection for a while. Once the volatile period is passed, the costs tend to go down. And so instead of saying, let's say, 5% protection for a month, let's say it's more like 3%. I do not know. I can't say what it's specifically going to be, but 3% for protection per month times 12 months means it's going to cost us approximately, in that hypothetical scenario, 36% per annum for protection on our stock if we just don't want downside for the most part. Actually, we think we've protected the position, but what we've actually done is really increased the cost of doing business here. So to come up with, to offset the 36% cost of protection for the year, and again, 36% is not the guaranteed amount. Could be more than that, might be less than that. I don't know, just using a hypothetical here. But how good is the trader if they're spending 36% for protection? That must mean that the thing that they are protecting needs to increase in value by at least 36%, if that's the cost out of pocket. How good are we at picking stocks that are going to go up at least 36%? That's tough. That's tough. So that really illustrates why for some traders, they're very selective about using strategies like this, typically implemented at times when they think the downside risk justifies the cost temporarily for protection. All right, there we go. So that is our married put. We now understand that yes, it delivers protection, but also it comes at a cost. All right. But how do we place this trade, and when might the trader choose to get out of some or all of the position? Here's how the trade's placed. We'll go to the trade tab. We can actually do it a number of ways. One way to do the trade is to click on the ask price to buy the stock. By default, this is going to be for 100 shares. I'm just going to stick with 100 shares. Now, at the same time, let's just click this little down arrow. This is just going to hide the purchase order that we have down at the bottom. It's just waiting for us down here. And then we go up to the options chain, go to the option that we were considering buying, and while holding down the control key on our keyboard, I'm going to click on the ask price for the option that we're going to purchase. Oh, not going to allow us to create the custom spread. That's okay. We'll do it as a separate transaction. But let's buy the stock. But as we do this, I want to make sure that we talk about, not just when we enter the trade, but also how we might choose to exit all or a portion of the trade. There are circumstances under which a trader might decide, you know what, I don't need the protection anymore. I'm going to get rid of that. There are other circumstances where the trader thinks, the protection's been nice, but I don't want to own this stock anymore. I'm going to get rid of all of it. So, did that answer your question there, Kadar? Very good. All right. But let's go down here. I'm going to buy the shares. Let's expand our column back up. Buying 100 shares of Carnival Cruise Lines. We're buying this. This technically, the logic of the entry here is because of the long-term outlook for the stock. Maybe the trader just thinks that it's likely to go up. They don't mind buying right before an earnings announcement because sometimes that pays off handsomely, but they also don't want the full exposure to the downside. So there we go. So let's go finish our purchase here. How about for today? Let's enter this as a market order. I'm going to buy the stock at the market price. Buying 100 shares of Carnival Cruise Lines at the market. No commission for this trade. There will be on our option trade. With market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. So looks like it might be around 3106, 3107. It's not guaranteed. Let's send that order off. And okay, we bought the stock. Notice very closely, $31, 3107. So now let's go back to the 31st of October and buy that put. We're going to click on the ask price. That's going to bring up an order by default for 10 contracts. That's on 100 shares each. That'd be 1,000 shares worth of protection. We don't need that. Let's take that down so the protection matches the asset exposure of 100 shares. So we're going to buy one contract, buying the 31st of October, $31 put. Looks like it might be about $1.78. That's a natural. I'm going to say that we're willing to spend that. $1.78. Let's lock that as our limit. Click confirm and send. Putting in an order to buy the 31st of October, $31 put for $1.78 maximum. That's the limit that we're willing to spend. If that fills, there would be a 65-cent commission, bringing the maximum spent to $178.65. We'll see. We're going to have to see if this fills. Let's send this order off. And yeah, we bought it. Okay, bought it right at 178. Okay, so now we're in. Now the trader might feel a little bit more comfortable riding out that earnings announcement. They know if the earnings goes really well, they're still in position to take advantage of much of that upside. They may lose the invested amount in their put, but as long as the stock makes at least that much or more, then we're in good position. If the stock falls, the trader has the right to sell their shares for 31 bucks. So if it collapses $6, $7, $8, $9, $10, they still have the right to sell for $31. Now they did spend, in this case, spend $1.78. So if the stock only falls to 30, let's talk about that. What if the stock doesn't fall very far? What if it just goes down here to 30? Well, the trader has the right to sell their shares for 31. So that's a dollar value that we spent $1.78 for. So in that case, even though the stock went down, the protection wasn't worth the investment. That makes sense? It's only if we get a strong move to the downside of at least $1.78 where this really delivers that value at expiration. All right, so final thing I wanted to talk about. When might a trader decide to pull the plug on a part or on all of this position? Well, let's talk about partial exit here. Let's say that our stock starts to rally. Let's say it's going up. It's moving toward expiration. We're past earnings. Maybe we've gotten through that initial choppy couple of weeks that we thought might happen, and not much has happened. Stock's just going up more gradually than we might have thought. How about let's say we're up here at about 33.5. And what's the date today? The 23rd. Our announcement's on the 29th. Let's give it a week past the 29th before our trader makes a decision. So let's say we're looking at this maybe October 5th, 6th, 7th, something like that. All right. So let me shorten up my line here. Actually, let's clean up the chart. Let's remove this drawing. Let's remove this little drawing here. And that's okay. So we can just focus on this one. So let's say by the 7th, 6th, that's about a week past our earnings announcement, our stock's making its way up. We don't have this staring us in the face any longer. And the share ownership's doing just fine. We're past the spookiest part. Doesn't mean the stock couldn't decide to just head down for some other reason, but we've gotten past the earnings announcement. Well, at this point, the trader might decide, you know what, I don't need that protection any longer. Maybe I'll go sell it for whatever I can get out of it, because that contract would still have a good period of time remaining on it. This is still basically a month, let's say about 4 weeks till that expiration. Maybe there's some value they could retrieve out of that, and they're not going to be out the full 178. So let's go run a quick hypothetical. Let's assume that we're up here at 32.5 on October 6th. How much might we be able to sell this contract for? Well, if we go to our trade tab, there's actually a tool here, right here where it has delta, theta, and vega. I'm going to change this to the theoretical price tool. What this allows us to do is calculate future theoretical prices on options. So what we'll do once we've selected that tool is choose an anticipated date. And we were talking about October 6th. We were also talking about price moving. Right now it's about 31. Let's say we think it's gone up to about 32.5. That's up about $1.50. So let's put in $1.50 up. Now, let's make no assumption about what volatility does. Okay? But as we put in our assumptions, so price going up $1.50 by October 6th, we can then look at our column titled Theo price at the strike price that we purchased and see how much the expected value of that option would be at that time. So at that point, if the stock has gone up about if it's gone up about $1.50 by October 6th, it would theoretically have about an 83-cent value. Now, it would probably be less than that, I'll say, because with an earnings announcement, that's a very volatile time. Volatility typically settles down, and that can bring the price of options down. But we might be able to get 60, 70 cents back out of this put at that point. And therefore, maybe we lost $1. All right. Well, in that case, the stock's gone up $1.50. The protection, it wound up costing us a net $1 to get us through the rough patch. and the trader's doing okay. But at that point, the trader might just consider selling that put. So we just go in, put an order in to sell that put. Well, that's a partial exit of the position. We've gotten out of the protection, but still retain the stock. There could be a time when the trader says, you know what, I don't even want the stock anymore. When might the trader decide to get rid of everything? Well, in that case, it might be if the stock is falling. Let's say it's reversing its trend, or maybe the traders just decide for whatever reason, they decide not to own the shares anymore. But very typically, if it was a technical purpose for getting into the trade, meaning we use the chart for that logic, it's very likely going to be a chart decision to get back out of the trade. Let's say this earnings goes poorly. So after the earnings announcement, the stock starts moving down. Let's say it's really gone down. We have the $31 put. Our stock has fallen down to $25. Well, at that point, we'd be looking at a $6 loss on our stock, unrealized loss. But the put would have at least $6 of value in it. This is where it's really helping us with this exit. Why would the put have $6 worth of value? Well, it's giving us the right to sell our shares for $31 at 25. So if we were to exit, there would probably be a nominal loss on the trade, a smaller loss certainly than if we just own the shares. But yeah, if it gets to the point where the trader no longer wants the shares, maybe they choose to just sell the stock and sell the option. I'm not going to do those trades today. We'll see if we can follow up on this in a future webcast. But those are some potential exit scenarios. All right. So let me see if I missed any other questions. I think we're good there. But guys, this has been, I think, a pretty good introduction to this strategy known as a married put. We understand what a married put is. We understand when a trader might choose to use it. We also recognize that it carries some potential advantages, but it also can certainly carries some potential disadvantages. So it's always up to the individual trader whether a strategy is going to play a role in their portfolio and at which times it might play that role. But everybody, thanks for giving me your time today. We will explore additional strategies next week. We do this webcast series weekly. Now, I have other webcasts throughout the week, so you're certainly invited to join me in those. But I want to make sure as I let you go to enjoy the rest of our educational offerings for the rest of today, that you are aware of the full range of educational offerings from Schwab, and you're in position to take advantage of those to the fullest extent. So first of all, first recommendation I have for you is that if you have not subscribed to our Trader Talks channel on YouTube, do that now. Our Trader Talks, so the full name of the channel is Trader Talks Schwab Coaching Webcasts. But this is where we house our archives of completed webcasts. So pop down in the lower right-hand corner. You can click on the subscribe button right there. It only takes a second. It doesn't cost anything. But you can find our playlists here on the channel. You can join our live streams right here. You can even do searches for topics of specific interest. For example, Ben Watson did a nice discussion of married puts. You can just type in married here, do a quick search. Oh, sorry, it wasn't Ben, it was James. Callers and married puts right there. Popular coach for a lot of really good reasons. You might want to check that out. Now, another thing that I would suggest you do is if you have an account on X, make sure that you're following your favorite presenters there. It's the best place to connect with your favorite presenters in between these live streams. You can find Kevin on X at Kevin Horner CS. You can find me on X at Cameron May CS. And here's something that's interesting. My impulse still is to say Twitter. Go follow me on Twitter. So I asked my followers on X, hey, when talking with a friend about this app, X, what do you most commonly call it, X or Twitter? To me, it just rolls off the tongue better. It's more specific. X sounds incomplete for some reason, but anyway, it is called X. So you can, if you reply to my post, I just try to reply right back to you. Sometimes it's just a topic of interest to me. Other times it's going to be learning about the markets. So for example, I release videos on a regular basis to demonstrate tools you can check out. I'll ask for a discussion on maybe things that we're learning on a price chart, all of that kind of thing. So everybody, thanks for giving me your time and your attention today. Thank you to everybody that's already clicked the like button or the thumbs up on YouTube. That always sounds like applause to your presenter. But beyond that, beyond a nice electronic pat on the back, a digital pat on the back, it promotes, just to a small extent, but it definitely helps. When you click on like, it lets YouTube know, oh, people like this webcast, and they show it to more people and allows more people to find these sorts of discussions and learn things like, what is a married put? What are the pros and cons? When might a trader choose to use one if they're going to use them? Oh, Sal says, did we come back to capital efficiency? Thank you, Sal. Yep. Let me address that quickly, and then I'll let you go. So if you'll notice, this strategy has unlimited upside, but limited to the extent of the cost of the put. It has limited downside risk. Well, that's pretty good description of a call option. We buy the call, cost that call limits the upside to some extent, but we have unlimited upside potential. And really, you can only lose the amount invested in the call to the downside. So limited downside risk. Very similar profile. But unlike a call, with a married put, the stock itself doesn't expire. Right? So that's an important distinction. Also, it carries rights and like voting rights and dividend rights that are not available to long call owners. All right. Good call. Thank you, Sal. Anyway, everybody, thanks for joining me today. I will look for you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.